Yeah, very good evening to all friends and professionals. My name is Surya Narayan. I'm the Gym Finance and Company Secretary for JIT Hotels and Research Private Limited. Before starting of the meeting, I will lay a brief context of what is in store for us today. Today, we have a very important and interesting topic for discussion. As you are all aware, 21-22 is going to be a learning and updation year for all of us, for all professionals like us. Since the volume of amendments and under all the acts, namely Companies Act or Indirect Taxes Act or Direct Taxes Act or Valuation, IBC, and that too immediately after the post-pandemic situation, it is going to be a really challenging task for all of us. So learning and updation for all of us, for all professionals, is going to be the primary task for all of us. Today, we have a very, very important and interesting topic for discussion, Schedule 3 latest changes in the Companies Act 2013. We have two eminent persons as technical speakers, CA Dr. Gopalakrishna Raju, known as GKR, and CS Dr. S. Dhanapal, and I welcome both of you, sir. Dr. GKR is a practicing chartered accountant and a partner of Gopal Rao & Co. Chartered Accountants, and he has got a host of qualifications besides his name. And good afternoon, sir.
Thank you.
And Dr. CS Dhanapal is a company secretary and an advocate and a managing partner of Mrs. Dhanapal Associates practicing firm in Chennai, CS firm in Chennai. Also in insolvency professional and recipient of many awards like Best Citizens of India and a host of other awards. I welcome you, sir.
Good evening, sir.
Very, very good evening, sir. Before going into the session, I would ask all the participants to make this debate a very lively one and interactive one. And I would also like you, all of you, to subscribe to this channel to get notifications which are very relevant to all of us, because this is going to be the channel which is going to give a lot of information to our professionals. Sir, before going into the main discussions, I will place this question to Dr. GKR. Sir, just wanted to start regarding the applicability of this amendment to Schedule 3. Sir, it was amended on 24/3/2021. It says with effect from 1/4/2020. Whether it is applicable for financial statements for the period ended 31/3/2021 or for 31/3/2022. Sir, whichever way, sir, we understand this, all these changes are substantial, very significant, and we need to have a very deeper understanding to advise our clients as well as professionals like us who are in the employment field, sir. I would like you to brief on this, sir.
Sir, thank you very much, Mr. Surya Narayanan, and my co-panelist, Dr. Dhanapal, and all the virtual participants. A very, very warm good evening. This changes in Schedule 3 of the Companies Act is a very, very important change. In sync with CARO. CARO was supposed to be implemented previous year, and we know it was deferred for 1 year. So point number one. Point number two, this particular notification has made changes to all the three divisions. Division 1 is for the accounting standards applicable company, and Division 2 is for NDAS, and Division 3 is for NBFCs. It is applicable for, so they have, so you will see a lot of similarities in the notifications. Number 3, the applicability. This is one question is there lingering in the minds of every reader, professional, and also industry. The notification very clearly mentions that this particular further amendments in Schedule 3 to the said effect with effect from first day of April 2021. So that is the wordings used there. My view, my understanding to this is point number 1, all financial statements pertaining to the year 21-22. 21-22 only this particular notification is applicable. But when we are going to present these additional information as well as the additional regulatory information in the form of notes and disclosure for the financial year ended 31st March 2022. That is for financial year 21-22. There will be a necessity to give the comparative information with respect to 31st March 2021. So therefore, my view is this is a right time. So 1 year before itself, they have brought this notification so that the industry is geared up for 31st March 2021 also. Presently, may not be applicable for signing the financials to implement these. But my view is it will be in the good interest and also in the best interest of the stakeholders that voluntary compliance by the companies to these additional disclosures will help them to do the comparatives for 31/3/2022. Thank you, sir.
Fantastic,
Next.
sir. Fantastic, sir. Thank you, sir. My next question will be to Mr. Dhanapal. Sir, kindly throw some light on shareholding of promoters and changes in equity, sir, disclosure requirements.
Yes, sir.
Amendment.
Earlier, if you see Schedule 3, we keep giving lot of information on share capital. There's a separate a line item for that, for giving the details of the share capital, all that. But earlier, that promoters detail, we don't give with the names and all. But now, if you see the amendment makes it clear that going forward, since it is become effective from financial year 21-22, so for any financial statement which is concluded 31/3/2022, now along with other information which has already been provided by companies under Schedule 3 under the heading of share capital, they should also start mentioning about or recording about details about the promoter. Like, see that the first time I remember the promoter's name is insisted in the Schedule 3. Now, it's not, we can say that it's any other, it's a simple amendment that we can simply take it as a one more compliance. No, it is going to be really a very important change in the corporate sector, because the name of the promoter is going to be revealed in the balance sheet itself. Because though we are filing other MDT 7 and annual return where we say shareholding give a shareholding pattern and directors detail, all that, but in the balance sheet or financial statement Schedule 3, okay, which is prepared in the format of Schedule 3, it never happened the promoters' names are reflected. But here, the first time the names of the promoter should be reflected, that is made mandatory. So name of the promoter has to be given and the number of shares to be given, and also the percentage of the shares, how much percentage they hold. That also should be given. In fact, we keep giving to the stock exchanges for listed company, the promoter details and all this category, we keep giving to stock exchanges pursuant to the SEBI, LODR and other regulations. But for normal companies, unlisted companies also, now the MCA is making it mandatory. Now the amendment has come, wherein they have to give a promoter detail also part of the share capital. One important thing here to understand is, I was wondering that to read this, who will be deemed as a promoter? So it's a big question, because we keep always get confused. Who will be the promoter? Because promoter, certain times they will be the investor alone. In certain companies, they will be active management. Certain companies, they will come on and off. So who should be deemed as a promoter? Of course, for listed companies, we make it clear because there is a regulatory requirement, means procedural reporting requirement, where we have to say who are the promoters. But for unlisted companies, earlier it was little difficult to identify. Now, by bringing this amendment, MCA is casting upon responsibility of the company that they have to mention the name of the promoter, shareholding, and percentage. Now, if you see the definition of the promoter and the companies at 13, it says promoter means a person who is named in the prospectus. That's understood. Who named in the prospectus as a promoter, should be deemed as a promoter. It's understood. Or is identified by the company in annual return. In annual return, if it is identified promoter, is understood. Okay. Then that means a person who has a control over affairs of the company directly or indirectly. Here, please, we have to understand one important thing. Here, the promoter is also a person who has control over the affairs of the company, not only direct way, even if he is having an indirect way also. So, which whether as a shareholder, director, or otherwise. So, meaning that it's not that it should be a shareholder, it should be a director. That's what it is going to conclude. Means the conclusion is going to leave us that a promoter need not to be a shareholder, need not to be a director. He can be any other person also other than the director and shareholder. Still, he can be deemed as a promoter. Please understand, because by means of indirect thing, they will bring that person also promoter. The third category is that or instruction the board of directors company is accustomed to act. This is another thing that we have to say, where generally we see this class to make a deem a company as a subsidiary or not. We always see this whether the board is accustomed to act with the direction of the parent company so that to deem it as. So this is third condition. So it is going to be a really whose name into the promoter, and at the same time they have to comply the definition of the Companies Act 2013. Over to you, sir.
Oh, thank you, sir. Sir, my next one would be to Dr. GKR. I would request you to throw some light on the trade payables and trade receivables, sir. Aging schedule. I would like to throw some light on that.
Generally, this trade payables and trade receivables, we'll have only two categories. And what is it? Less than 6 months and greater than 6 months. Second, because of the necessity under the MSMED Act, there is a additional requirement to disclose what is the classification of payables to micro, small, and medium enterprises. So this was the earlier requirement. Now, this less than 6 months and greater than 6 months has now been further classified. And we can see, especially post-pandemic, the amount of the mounting payables, I'm sure it would definitely cross not in months, but also years. And especially in companies, the moment you say more than 6 months, many of the chunk of the payables are more than 6 months, and minority percentage is only in the less than 6 months category. So this doesn't give much of clarity. So who is payable more beyond 1 year, and similar is with respect to receivables also, from whom we have not collected. So generally, we have a classification in banks called good and doubtful, and then bad debts. So therefore, the moment we have crossed 1 year or more than 2 years, the question of doubtfulness and whether you have considered the credit risk and whether it is impaired, and under financial instruments, India is 109. Very clearly, they have mentioned that sundry debtors, if it is impaired, you have to create a impairment provision. Similarly, with respect to the credit risk also, you need to provide the provision. So therefore, this classification is a step one towards that. So therefore, now they have classified your trade payables into MSME and others, which was already there. But one more additional classification they have brought within this. What is disputed to MSME? What is disputed to others? This is one very, very important one. Why? Because thanks to Insolvency Bankruptcy Code. Under Insolvency Bankruptcy Code, if the dues are disputed, especially for operational creditors, if the dues is default, I repeat, if the dues is default, but not disputed, it will actually go through for insolvency. It will be admitted. But moment it is disputed means the company has to actually disclose it. So therefore, audited accounts classifying this under the disputed category is a one-way protection for the company in facilitating them to actually make a point before my lord that this is a disputed. Already we have disclosed in the balance sheet, so therefore this will not be eligible for taking up before NCLT forum. This is a very, very important change that has been brought out. I think corporates have to look this from that particular perspective. And today you can see even a couple of days back, one of the operational creditor with a few lakhs only due, he has actually gone to court and it was admitted. And that company is none other than the most popular Oyo company. So therefore, and they have now appealed against that particular order to NCLAT. So all this can be avoided if the moment you have classified under dispute. So this is a very, very important change. The same is the case with trade receivables also. And this is one place where disputed means there is some evidence should be there. So from audit perspective also, this is important. And undisputed trade receivables means good. Disputed trade receivables, considered good, considered doubtful. This is very, very interesting. Of course, with respect to undisputed, I understand, but with respect to disputed, considered good, considered doubtful. So this is a place where we need evidences, and this will actually help the auditors, especially with respect to the documentation part of it, and whether it is Apas ki Mamla, it is only between the two parties, or have they gone for a third forum, like an arbitration or any other forum. So all this will actually give clarity to give those classification, and that will actually enable not only classifying, but also age-wise we need to give below 6 months, 6 to 1 year, 1 to 2 year, 2 to 3 year, and above 3 years. So naturally, if the chunk of the figure is above 3 years, investor will definitely question, and auditors also will have the point very clear. Why not put a provision for this, and why not the company take it forward for writing it off? So all this point will automatically emerge. Good, sir. Thank you very much.
True. Sir, my next thing would be to Mr. Dhanapal. Sir, I would request you to throw some light on title deeds of immovable property not held in the name of the company.
That's the brought in the Schedule 3. In fact, here also this is another important, which I told earlier, the promoter detail, shareholding detail. Similarly, now disclosing the details of titles of immovable property not held in the name of the company. That's furthermore, it is going to be a real challenge, particularly to the statutory auditors who is going to undertake the audit. The reason being, if you see, so going forward, now the Companies Act makes his mandate that the details of the immovable property, the name of the title deeds of the immovable property, whose name means not held in the name of a company, should also be given. That means the company shall provide the details of all immovable properties, okay, whose title deeds are not held in the name of the company in the format. They are given one format, where the land and building, description of the property, and title deeds held in the name of whose name it is there. Now, if you see the challenge here, now, if for example, a person is a statutory auditor of a real estate company or a developer, of course, normal, even other than real estate, normal company also. Say, for example, a company is owning a land. So now it becomes a duty of the statutory auditor to make sure that every title deed is seen by a statutory auditor, to ensure that whether the property is standing in the name of the company or not. Because if its property is not standing in the name of the company, that means the title deed is not in the name of the company, it becomes a responsibility of the company to report in the Schedule 3. If it is not reported, then it is a duty of the statutory auditor to qualify it that it is so and so detail is not being reflected, which legally has to be reflected. Now, earlier at least the details of the property were reflected, and whatever the company owns the property, those details used to be reflected, and it comes in the fixed asset schedule, all that. But now, earlier, generally when the property is not, that means the title deed is not standing in the name of the company, then generally a company also may not feel it necessary to bring it, to mention it that the company is the owner of the property, since title deed is not there. But the money would have gone out of the company, or it would have, the transaction would have took place. But title deed alone may not be in the name of the company. Title deed means sale deed. We have to take it that way. The title deed is sale deed. See, there may be a transaction earlier also. A title deed may not be in the name of the company, but the money would have gone, the consideration would have gone from company, or some other than consideration would have gone out of the company, whereby the land would have bought, maybe not in the name of the company, maybe bought in some other group name company, or some other director's name. All that used to happen, probably by ignorance also they may do sometime, or probably some practical difficulty they would have done earlier that way. But they would have brought within in the books that the company owns the property, but the title deed will not reflect the name of the company. Now, it becomes responsibility and duty of the company to disclose of those transactions where the company owns, or it says the company owns. That means the company claims that it is the owner of the property, but the title deed is not carrying the name of the company. So that it become mandatory going forward from 21-22 financial year that the companies are reporting details of all the property and properties which is not standing in the name of the company, but which company claims as the owner. At the same time, it should also disclose the name against whose name the property the property is held should be shown, and also the gross carrying value of that property. All this is going to be a real challenge that the statutory auditor will be given a responsibility to ensure that company reporting all the transactions, means that the transaction relating to a title deed, though the company owns the property, but the name is not appearing in the sale deed. So all this is become a responsibility of both company as well as the statutory auditor of the company to report it. Thank you.
So we have one doubt. If the company is a lessee company, in whose name the
this lease transaction alone has been brought outside the scope of this transaction.
Okay, that's what I want to ask.
This lease transaction is not, because it's very clear. See,
Okay.
it made it very, the MCA, if you read that Schedule 3, it make it very clear whose title deeds are not held in the name of company.
Okay. So,
But the company claims as a owner. Company
Correct.
claims as a owner, but the title deed does not reflect the name of the company. That means lease deed and all that is excluded from the ambit of this reporting.
fantastic.
Thank you.
What Dr. Jigar, what I could see is like it's more in the amendments are more in sync with Ind AS, probably Ind AS 16. What's the opinion on that? I think probably we are all bringing it together.
Not only with respect to Ind AS, but before year, CARO has introduced. And CARO has made it very clear, especially one particular point called as whether the company has revalued its property, plant, and equipment, including right of use assets, that is, with respect to leased assets and intangible assets. And most important, please watch this, that if the change in revaluation is more than 10%, then you have to mention that particular amount separately. And in sync with this CARO audit report requirement, which is the point number 4, they have brought this change in this particular notification. So therefore, I only visualize this as a a year delay, it should have actually come along with the Caro order.
Okay, sir, my next question will be to you again.
No, just to add another point here, just to add to JKR, whatever JKR shared. See, here earlier there was no requirement or specification that if any revaluation is done by the company, it should be done by registered valuer. Please note now explicitly it has been brought in both in CARO and also in the Schedule 3 that if at all any revaluation of asset is done, it should be done by the registered valuer today, as per the registered valuer rules which has been effective from 2017, as we all aware. So now earlier that requirement was not there.
This is why I want to just supplement. Generally, in the Schedule 3 notes, there was no connect with respect to the regulatory part of it. Regulatory part of it. Now they have brought it under a separate notes called as additional regulatory information. So wherever there is a necessity to refer to the mandate under the law, it has been brought under this. So it is very nice that this particular notification takes care of the mandatory requirement, and indirectly, rather than bringing this as part of Ind AS, this is actually a 4-year, 5-year long pending expectation. Management only has to do the valuation. That is what the Ind AS says. It is a responsibility of the management. Now, who will do the valuation under Ind AS? The Ind AS is silent about it because there the prescription is only with respect to accounting, measurement, disclosure. That's it. Therefore, here under the Companies Act and as an extension of the Companies Act Schedule 3, they have no mandated. So it's very, very, I will call this as an important.
Yes, that's why at this point I mooted, because Ind AS does not make it mandatory that valuation should be done by outsider. Ind AS says the valuation should be done inside, even by board of directors or any other internal person. But now, since it is specifically now casting upon the responsibility, but the revaluation of assets should be done by registered valuer. Now it is traveling beyond Ind AS and making it mandatory that revaluation should be done only by the registered valuer. Though internally the board do the revaluation of assets, but it should be tested and confirmed by a valuation report by registered valuer. Thank you.
Thank you, sir. Sir, my next question will be to Dr. JKR. Sir, I would like you to brief us on both the assets, tangible assets, intangible assets. And more so, I would like you to elaborate on 3 aspects. One is the reconciliation. Second is the intangible assets under development and revaluation of intangible assets. These 3 I would put it to you, sir.
Sir, there is a major, I will call it as a facelift that is given by this particular notification. Number 1 is with respect to, of course, you have 3 divisions in Schedule 3. Division 1 is for non-Ind AS, Division 2 is for Ind AS, and Division 3 is for NBFCs. In Division 2, which is for non-Ind AS, even now the word is called tangible assets. So therefore, they have now renamed that to property, plant and equipment. So it is not only a name change, but also they have brought a very, very important change. Now I want to make one important observation. What is that? We need to give a reconciliation. Now, what is this reconciliation? What is your opening balance? What is your closing balance? What is your addition and what is your movement? This is gross. And similarly, depreciation also you must give. So, gross minus the depreciation, movement of depreciation, will have the net. This is what is called as the reconciliation statement. But here, they have brought one additional input. What is that? The amount of change due to revaluation. So this is what I mentioned with respect to CARO. So what is given in CARO has now been, so you can actually think from a perspective of an auditor. As an auditor, I need to comment about in CARO, but nothing is actually been disclosed in the financial statements. So then CARO reporting seems to be actually like an additional burden. Maybe an internal information I have to take and then I have to report. So therefore, Unless and otherwise your financial statement has those information, it will be appropriate for an auditor to comment about it. Yes, it is not there, I will comment. So what is to be given in Schedule 3 is amount of change due to revaluation, especially and other adjustments and related depreciation and impairment shall be disclosed separately, provided if change is 10% or more in the aggregate of the net value of each class of property, plant and equipment. So naturally, revaluation, whenever the management decides, my view is it will be more than 10% only, and it will be substantial. And the property, plant and equipment, India 16 has two model. One is cost model, another is revaluation model. Initial recognition is cost model, but the subsequent measurement, you have a choice either to go for a cost model or revaluation model. So when you adopt a revaluation model, then if I do the revaluation, taking the help of a registered valuer, then there is a necessity for me to disclose separately what was before revaluation. For example, before revaluation, it was 75 lakhs. And after revaluation, it is 4 crores. So naturally, it is not even 10%. It is beyond, what do you call it, as 300%. So even close to 400% and above. So therefore, this particular, and this will give you the, and for your information, whenever I feel I need to actually balloon the financial statements, Ind AS 16 gives me the comfort. I will adopt a revaluation model and I can balloon the balance sheet, this side and this side in what do you call this revaluation surplus, and my assets I can actually lift it up, showing the fair value. So there I need to actually very clearly inform the stakeholders, look, this particular year, the substantial revaluation has been made more than 10%. And as an auditor, I will comment in my para number 3D also. So this is in sync with my presentation. So that is a very important change. And one more second part of your question is with respect to capital work in progress and intangible asset under development. Actually, there are 4 items in your fixed assets. One is property, plant and equipment, intangible asset, capital work in progress, intangible assets under development. So out of these 4 items, only one item will be very clear. You can see by eye. Other 3, it may not be clear at all. One is intangible asset, second is capital work in progress, third is intangible asset under development. Both the stakeholders as well as the authorities, tax authorities, they will be perplexed with these particular terminologies. Intangible assets itself is you cannot see. Intangible asset under development, India is 38 makes it very clear that if you have to capitalize it, there are 6 conditions given. And all the 6 conditions you have to satisfy. Then only you can capitalize it. Number 1, you have an economic benefit in future. You are very certain that the development will be completed within a certain period of time. So all this. Now I want to make one very important observation for government companies, especially capital work in progress. Whenever it is in capital work in progress, nobody will ask questions. Even auditors also doesn't ask questions. Oh, it is in work in progress. Let it first come to asset. Then the question about amortization, depreciation, ityadi, all those stuff. Now, there is a concept called time overrun and cost overrun. I repeat again, time overrun, cost overrun. I originally expected it to complete in 24 months. But now, even after 48 months and even after 60 months, it is still under in progress, especially housing companies, construction companies, infra companies. There is a cost overrun. And why my company is not doing well? Where is the money? They are always borrowing. My profitability is very low. This one particular table can actually connect it to my profitability because my cost is overrun. And I have to, this capital work in progress, they make it very clear. What is project in progress? Less than 1 year, 1 to 2 year, 2 to 3 year, more than 3 years. Number 1. Number 2, they say you have to give one more table where the completion is overdue or exceeded its cost compared to its original plan. I will say an amazing thought has gone into it, but disclosing all this information, you are opening Pandora's box. And I'm sure all the investors will line up and will shoot questions to the board of directors left and right. Left and right. So left and right, they are going to do this, and it is going to be challenge for the entire industry in coming out with this. But one way it is correct. What it will actually substantiate. They need not explain why dividend is not declared, why profit is low, why they are going for a borrowing, why they need more money. This particular table will give answer, but they have to come out with the reason why it is delayed. Very interesting change there. Thank you.
And it also says the details of projects where activity has been suspended shall be given separately.
Why, for example, due to COVID, due to approvals delay, part approvals given, for example, pollution control. Pollution control, you have actually violated some. Pollution control department is very strict. Year after year, the norms have been made very stricter. So not only that, not only with respect to water pollution, air pollution, not only that with respect to electricity board, with respect to lift, so many power related clearances, all clearances, there will be a delay in your projects, or part of the project will be delayed, and or one part is delayed because of that the entire project is halted. So you need to actually, so therefore the disclosure will actually go into your operational inefficiency. It will actually open up whether it is operation inefficiency or it is a government, it is a default on the part of the authorities. So all this will actually unravel. Very interesting.
Thank you, sir. Sir, my next one would be to Mr. Dhanapal. Sir, now it seems that the source of every assets has to be given now in disclosure for details of Binami property held. I think
Yes, now in fact it is little related to my earlier question which I answered, that property not held in the name of the company. Okay, that's the reason that they were asking the details of the properties which is not held in the name of the company but somebody else. So that's the idea that they are asking these details. But under that Binami detail, if you see, they specifically asking, is there any proceeding have been initiated or pending against the company for holding any Binami property under Binami Transaction Prohibition Act 1988. Okay. The company, what are the details that it should disclose? If you see the detail that should be disclosed, detail of such property including the year of its acquisition and amount thereof, whatever the amount is involved in that, then details of the beneficiary, and if the property is in the books, then the reference to the item in the books. If you see what is this Binami, why they now suddenly the government started too much giving importance on this particular aspects, Binami property. That too, earlier we keep reading a lot of information moving around about Binami Transaction Act, all that. Very interesting to see. See, now details of Binami property held or not should be given. Now again, I will tell you that now again the responsibility is cast upon to the auditors is more. Why I am saying like this? Companies, of course, they will try to give the detail, but whether the company has disclosed the detail properly or not, how as a statutory auditor one can understand. I'm just wondering how a professional who is involved in audit, he will understand. For that, then the professional also should know what the Binami Prohibition of Binami Property Act 1888, what it says. No, Prohibition of Transaction, Binami Transaction Prohibition Act 1988, what it says. How to bring one particular transaction into Binami transaction. Then that means a professional also should know. It's not that the company alone should know. It is very interesting if you see the Binami Transaction, Prohibition Act 1988. What other transactions are brought under Binami transaction? It is very difficult. Means what you say that not even I can say difficult. There are many parameters is given. Say I will tell you that what are the Binami transaction which is provided, which is defined under the Binami Transactions and Prohibition Act 1980. If you see that a transaction that will be deemed as a Binami transaction when where a property is transferred to or held by a person and the consideration for such property has been provided or paid by another person. So that means the same thing which I answered the earlier one. The title deed is not held in the name of the company, but the consideration would have been paid by company. So this will fall under the Binami transaction. And another condition that it should satisfy, the property is held for the immediate or future benefit, direct or indirect, of the person who has provided the consideration. So this also is important to prove that the person who has provided consideration with that motive that he may be using it immediate and future benefit, he has made the consideration for his direct or indirect. If the government able to make up this particular point, then they will directly bring the transaction within the Binami transaction. It's not stopping with that alone. That's only one point which I said. Same way, if we see a transaction arrangement in respect of a property carried out or made in a fictitious name. So that also coming under the Binami transaction. So one should understand whether the transaction is Binami transaction or not. Then they should know not only what I read. Again, another point I'll tell you. A transaction or arrangement in respect of a property where the owner of the property is not aware of or denies the knowledge of such ownership, then also it falls under the Binami. So Binami is not that simply you can say that it is not standing in the name. No. So it's not that. See, it says even if the owner, the company claims, no, I deny, I don't know how this property has been booked or been, then also it become a Binami property. And we see another point, a transaction or an arrangement in respect of a property where the person providing the consideration is not traceable or is fictitious. That means a person who made consideration, if he is not traceable, or if a government able to make out that it is a fictitious person, then also it will be considered a Binami. So these are the things one person should understand before concluding whether the transaction is a Binami transaction or not. Then after that it's become a responsibility of the company to bring it in the balance, the financial statement, those transactions, and if there are any proceedings are held, and declare what kind of proceeding is held, on what is the status of the proceeding, and what is the means compensation given by the company also, it should be disclosed in the Schedule 3. So very important.
I want to add to Mr. Dhanapal, there is a section called 24 of the Binami Property Transaction Act. It is a prohibition of Binami Property Transaction Act. Under that, if a notice is given, that is the trigger point for that particular sixth point. And it is given in all
attachment.
So therefore, I need not worry about whether the company would have done Binami transactions. That whether it has done or not is the secondary part of it, because that will have repercussions on Income Tax Act, that will have repercussions on the Binami Prohibitions Act. But if the notice is received, then I need to give the details in my financial statements, meaning these are pending. And I need to make one very, very important caution here. Under Income Tax Act, if the income is not disclosed, you are only liable to pay the taxes, interest and penalty. But in prohibition of Binami property transaction, the asset will be seized. So that is number one. Second, there will be a parallel initiation of income tax provisions also. Then third, there will be an initiation with respect to not penal provisions, in addition to penal provisions, prosecution provisions. So in Tamil, we used to call it as Mummunai Thakudal. So the what do you call it? Hit from all the three directions. One, asset will be seized. Okay. Number two, penalty. Number three, prosecution. So therefore, this has to be brought to the kind attention of the stakeholders that Govinda will going to happen if properly they are not going to address this issue. Okay.
Yes, that's right. That's why yes.
I think this can be. I mean, in fact, it has been cut paste from Caro. We can see that the roots.
Absolutely. That is why I made that particular point that you have to read this amendment.
Yes. If you have to report it, then it should be there disclosed in the financial statement. Then only it can be.
It is actually, for example, there is a what do you call it as a newspaper news. that so-and-so company Binami transaction has been initiated and government has given a notice. But nothing has been disclosed here. The company is actually contemplating to actually disclose. So therefore, then it is auditor's responsibility to bring in Taro. Now here, if it is disclosed, auditor will say, as per Benami property transaction, they have done all the disclosures properly.
Okay. Sir, I will shoot this question quick to Dr. Jigger. Sir, now this is the age of artificial intelligence and whatnot, sir. I would like to know more about disclosure on cryptocurrencies, sir. I will go straight away, sir, because we are also running short of time. I thought some important things can be discussed.
Sir,
I would also like to know what is the RBI stand on this, sir, because people are totally whether the company can invest in cryptocurrency. What is the position now?
Sir, point number one, I'll just put a question. You are GM Finance and Company Secretary. Surplus money, I am investing in mutual funds, fixed deposits, and in equity. If I invest in cryptocurrency, I will classify this cryptocurrency as cash in hand or bank balance or investments or equity, what I will classify. This is point number one. So you have a very clear, because this is not cash in hand, this is not cash at bank. It is actually pure investments, number one. Number two, with respect to, you have mentioned rightly about RBI. Reserve Bank of India, they have given two, I will call this as a press release or a notification. I'll call this as a notification. Number one notification is given on 24th of December 2013. I repeat, 24th of December 2013, that is a popular tsunami day actually. 24th of December, nobody can forget that. That particular day, they have given a press release called as RBI cautions users of virtual currencies against risk. So in 2013, they have given a press release saying that virtual currency risk is there, please be cautious. They don't prohibit. But in 2018, I have to mention, in 2018, 6th April 2018, they brought one notification. Very clearly, they said that entities regulated by Reserve Bank shall not deal in virtual currencies and provide services for facilitating any person. That means entities regulated by Reserve Bank means banks, regional rural banks, cooperative banks, and all the other foreign banks and private banks. They are not supposed to deal with the virtual currencies and funding, lending, anything they are not supposed to do. Meaning, RBI has actually washed their hands. You are at your own risk, you have to deal with virtual currency. So that is why if your company has invested in virtual currency, you have to give three information. Number one, have you made any profit or loss on that transaction? Disclose that separately. Number two, what is the amount of currency held as on the reporting, that is 31st March, what is your closing cryptocurrency in bitcoins or whatever format? Third, have you taken any advance from anybody in terms from corporates or anybody where you have assured them or there is an agreement saying that you are going to deal that money only in virtual currency? So today many such companies have been floated and they have taken money from many people, which is going to actually create because money, if it is actually the company's operating surplus, they can do it. But if I am doing it as what do you call it, as money taken from somebody else and I'm investing, then it is equivalent to doing it is almost like an extension of an NBFC. So therefore, they will be attracted under that. So a question can actually come further. So that is why these three are mandated with respect to disclosure, with respect to cryptocurrency.
Thank you, sir. Sir, next question to Mr. Dhanapal, which is very has got a huge significance in that. Sir, we just want to know about more about utilization of borrowed funds and share premium, sir. What are the disclosure requirements on that? I think this should be
Yes. In fact, there's a big requirement has been brought out in the Schedule 3. If you see that Schedule 3, they brought out a list of disclosure which has to be brought. Means when company has advanced or loaned any fund to any other person. See here, if you see that, it is nothing but you can remember section 186. I used to say earlier, if you see Companies Act 1956, Section 372A. Now the corresponding section is Section 186 in the 13 Act. If you see that 372A, always when we keep advising, we always say that the intercompany investment can be done only in the company. It cannot be done with the outside person. Because if you see the heading of 372A itself, intercorporate loans and investments, the heading itself like that. The heading of the Section 373 of 1956 Act, it sounds that intercompany loans and advances. That means it makes it clear that earlier in the 1956 Act, the company can only give loan or investment to another company. And we always keep saying that no, it is not permitted unless it is a company, because the section itself restricts it should be company. But if you see the corresponding section, Section 186 of the Companies Act 13, it says loan by company. It doesn't say to whom it can be given. Heading itself, you see loan by company. So that means it didn't stop to whom it should be given. It is opened up. I will say this disclosure also is nothing but the root is Section 186, because the Section 186 is opened up that it can be given. The company can invest and lend money, of course, subject to the compliance of the Section 186. If the limit is exceeded more than 60% of paid capital and free, so all those conditions are there, and the interest will be charged. All that is there, but it is opened up when the Companies Act 13 Act came into effect by virtue of Section 186. Now, section has opened up, but when transaction, whatever has happened was not recorded in the company financial statement. In fact, government or department must have got struggled to identify where the money has gone in, from where the money has come in, okay, and from that company where the money has further gone. If you see Section 186, it permits the investment up to 2 layers. So beyond 2 layers only it is not permitting. Up to 2 layers it is permitting. That means a company A can give to company B, then company B to company C. So, but earlier, if you see before this amendment, it is very difficult to trace the fund where it is traveling, means where it is moving on. Same way from where it is coming on. Suppose if there is a 1 or 2 chain is there, it is difficult to understand from where it is coming. So that's why to see that, to make it very transparent. So I thought MCA has brought this particular amendment whereby, see, every company should ensure that these details are properly brought in where the company is going in. In fact, if you see the word intermediaries, word is used here. So it is not only direct investment or direct loan, whatever the loan is given. No. And it makes very clear that a company has advanced or loaned invested funds to any person, any other person or entity, including foreign entities within bracket in. See, we know that investments keep coming from various countries. Okay, so to make it clear and transparent, the MCA thought, okay, that's better to make company to disclose everything. So today, after this come into effect, because from 21-22, if you see all this transaction which is happening through intermediary company, okay, should be reported, whether it is directly or indirectly lent or invested to any other person. All this detail has to be brought in. Not only that money lent or invested, also any guarantee provided. All this, what are the detail? If you see what are the detail to be, there's a exhaustive list. Date and amount of the fund advanced, loaned, invested, any intermediaries that should be given with the complete detail of each intermediary. Date and amount of fund further advanced and loaned by such intermediary to other intermediaries or ultimate intermediaries. That means it completely monitors. That means it makes it mandatory how the fund is traveling to track the entire journey. Means how the fund from where it is traveling, from there again where it is traveling further down. We call it downstream investment. Like this, how it is downstream it is getting invested. Also the date and amount of the guarantee, security, whatever provided to the ultimate beneficiary also should be given. And not only that, the declaration that relevant provision of FEMA has been complied. Please note, it is very important. Now the declaration become forming part of the notes on accounts. Suppose if there is no declaration, again it becomes the duty of the auditors to make sure whether this is in compliance with the FEMA or not. Because there is no declaration, then both the company and statutory auditor will become answerable if the company does not give that kind of declaration. So we should, going forward, every auditor should ensure whether this kind of transaction is recorded properly as per Schedule 3 requirement. Also, a declaration is given that this transaction is in compliance with the FEMA or not. So all this transaction is going to be completely making it open, not only giving loan or investment, also providing guarantee. All these particulars has to be given, and with the declaration that it is in compliance with the FEMA. It's a onerous responsibility given to the company as well as to the auditors to report it, to make sure whether it is reported properly, all these transactions, including the details of the ultimate beneficiary. It's more important, very important change that has been made, which is going to unfold a lot of information to the stakeholders. Thank you. Sound.
Sir, if you look at the crux of this particular utilization of borrowed funds and share premium, when you compare with the other disclosures, relationship with stuck-off companies, they are given a table. The trade receivables, they are given a table. But here alone, they are not given a table. They have given it open to the management. It is very, very sensitive. And point number one. Point two, the wordings that is used is called, two sensitive wording is called, one is ultimate beneficiary. Money has come in. From where money has gone. So I need not mention some of the very popular political party related cases and all are there, where ultimately the investing authority found out who is the ultimate beneficiary. Now here, the management has to very clearly say whether the money has been rooted or it is invested in the company. If it is a rooting machinery, I have to say where it is invested or from where it is gone, and it is a responsibility cast on the auditor also. So both of them are equally responsible to actually comment about this. So very, very sensible, I will call it as a disclosure that has been brought out. And I'm sure this is actually from an audit perspective. And the company has to also be very, very shrewd enough now to trace it even for 2021 and be ready for 21-22. So my suggestion to my all the corporate friends, professionals is that for 2021 also they have to be geared up for this, because CARO is applicable. So my understanding is they have to actually come out with these details even for 2021. Oh, sorry, sir.
Okay, two more questions.
Sir.
Two more questions. One to you and one to Mr. Dhanapal. Sir, I would like to know something on this undisclosed income. What is this regulatory information that is reported undisclosed income in the statement of profit and loss?
Sir, nowadays what is happening is there are a lot of scrutiny assessments, and in the scrutiny assessments, I would have declared an income of 7.5 crores as taxable income, but in the scrutiny, there would have been an addition of another 6 crores, and I would have disputed it, and I would have not won it, or I would have now paid tax for it. Now the question is, this 6 crores, which is an addition to my income, I would have paid a tax in the subsequent years. 6 crores I have to include as income, and the tax I should have paid. So that rectification entry, which is a prior period transaction, I would have entered it. So this doesn't get noticed at all anywhere. It doesn't get captured at all anywhere except the cash flow statement. But in cash flow statement, it will be as part of the total, so it will not be disclosed. So now you need to pull out that and say very clearly two things: what is the undisclosed income which has been assessed, and whether during the year have you paid tax for it, have you passed rectification entry in the books of account, yes or no. So these three, and again here also tabular format has not been mentioned, where corporates has to come out with how this has to be presented. So very, very, whether it is nil or not. So that is wherever the probability of nil will be there. You have not given a tabular statement. You have to come up with a. Thank you very much.
So one final question to Mr. Dhanapal, sir. The most hot topic of post-pandemic, sir, corporate social responsibility.
Yes.
Throw some light on that, sir.
In fact, yeah, now earlier government was very particular that the money has to be spent within the same year. Now, of course, they started relaxing. Now it has came to the level where if it is not an ongoing project, okay, it's a completed project, the company should ensure that they are opening a bank account and they are depositing the whatever the unspent money and ensuring it is spent on next 6 months. That they made it clear that with the recent amendment now. And if it is an ongoing project, if it is a CSR money which is spent, lying unspent, is related to the ongoing project, then it has to be transferred within 30 days to a separate unspent CSR account that should be opened by the company. And within 30 days, that money has to be transferred to unspent CSR account of the company. And within 3 years, they should ensure the money is spent within 3 years. Even then, the money is not spent, then it has to be transferred to the fund as notified by the government under Schedule 7 of the Companies Act 2013. Now, if you see the new disclosure that has been brought in under CSR, of course, we are giving various CSR information in various other form under Companies Act, but now they made it mandatory as part of the Schedule 3 itself that now going forward the company has to see that they are giving the detail about CSR, about amount required to be spent during the year, what is the amount that should have got spent, and the amount of the expenditure that got incurred, and shortfall at the end of year, what is that shortfall, and the reason for that shortfall, and what is the nature of that CSR activities, and what was the previous year shortfall that has been brought forward, and what is the related party transaction related to this CSR. All these details has to be spelled out from the financial year 2021 onwards in the balance sheet, in the financial statement itself, so that it becomes very explicit. It is easy to track all the corporate to see that what is the unspent money and what is the any related party transactions there or not, even in CSR. So it becomes very transparent and explicit going forward. So it gives additional responsibility to the company by disclosing more information about CSR. Over to you, sir. Thank you.
Sir, one final question, Jigar, sir.
Yeah.
Just take 2 minutes. Sir, regarding this ratios, disclosure of ratios, there is one complication says that no, you have to give explanation for any change in the ratio more than 25% as compared to the previous year. This kindly explain to this, sir, to everybody.
Sir, not only change. First of all, there are 11 ratios you have to give. One is
smaller companies.
Current ratio, debt equity ratio, debt service coverage ratio, and I think generally when as a teacher, when I teach ratio analysis, I used to say hardly 12 ratios are equally important for the entire company. Others are not that important, but so-so. But 12 ratios are equally important. And they have selected that 12 ratio and they have put it. Now, this is becoming a statutory ratio. All through these years, ratio analysis was only studied as a management accounting tool. Now, what is that 11? So, 11 is actually a modulus number. Okay, so 11, what they say is you read left to right, right to left, mirror image and water image, everything will be 11 only. So this 11 people should not forget in their lifetime. So the coming years and generation students, I am actually wondering that is going to be, and for you, me and Dhanapal, if second chance is given to write the company secretary exam or CA exam, I will actually surrender before institute and say sorry. Okay, so current ratio, debt service coverage ratio, debt equity ratio, return on equity ratio, ITR, inventory turnover ratio, trade receivables turnover ratio, that is debtor turnover ratio, and creditor turnover ratio, net capital turnover ratio, CTR, net profit ratio, ROCE, return on capital employed, and return on investment. All these we used to only give to banker for loan proposal or investor. Now it will form part of this in the balance sheet itself. Most important, I have to explain the numerator and denominator.
Right.
Okay, I have to explain the numerator and denominator. So they made it very clear. Shall explain the numerator and denominator in computing the ratios. Number one. Number two, compared to last year, if my ratio is maintained manageable, if it is 1/4 less or 1/4 more, plus or minus, I need to explain. No, I am very inefficient. No, my capital, I have not turnover, I have not done it. So these 11 is going to be, I will call this as when you go to a doctor will actually take stethoscope and see your nadi. Okay. And then he will say, okay, now here this 11, by seeing this 11 number and 25% plus or minus, you comment, the shareholder, stakeholders, everybody will understand company is going in right direction or not. Matter over. Case closed.
That will reveal the entire position of the company actually. If the ratio someone able to easily understand,
actually,
then we can easily
financial statement. I am not able to understand the line items. Originally you gave in T form, now you gave in vertical form. Even in T form, vertical form, I am not able to. You say extraordinary item, you say exceptional item. I am not able to understand. You say turnover, now you say total income, and you say other income. So now everybody will go to this 11 ratio. Straight away they will open this, see numerator, denominator explanation, 25% increase or decrease. Matter kada. They will not do P&L at all.
Yeah, that will reveal complete fate of the company. Whatever happened the whole year, that will reveal actually. Yes, sir.
So thank you very much, sir, both of you, and it was very great listening to you, sir. In fact, taking time off your busy schedule, both of you, coming and explaining to us, it was really fantastic for the viewers and me. Personally, also, I enjoyed the program. So thank you so much, sir. I look forward to something very interesting and challenging.
Two things I want you to just share it with the viewers. Number one, with respect to any questions they have, they can put in chat. And second, please request them to subscribe to this sessions and channel so that they'll get their reminders anytime.
Yeah. Thank you, sir. Thank you so much.
Thanks a lot. Thanks a lot, sir.
Thanks, sir.